All right, let's dive straight into this. There is a brand new IRS regulation now officially on the books that could genuinely put thousands of dollars right back into the hands of senior citizens, and it seems like hardly anyone is discussing it just yet. So if you happen to be 65 or older, you are going to want to pay very, very close attention right now. What we are about to walk through today could literally reshape the way you handle your finances throughout retirement for the next 4 years. This is seriously important information, so let's go ahead and get into it. The big question on the table is this: is there truly a new opportunity for older Americans to reduce what they owe in taxes? And the answer, believe it or not, is an absolutely resounding yes. But look, this is not just some minor adjustment to the tax code of the kind you tend to see come around every single year. No, not at all. We are talking about a significant shift, a genuinely fundamental change in the way the federal government is going to treat your retirement income. And quite frankly, if you let this one slip by you, it could end up costing you thousands of dollars that should have stayed right there in your pocket where it belongs. And here is the figure that should really make you stop and take notice: $12,000. That is the potential new bonus deduction available to a married couple who are both 65 years of age or older and who file their taxes together. Now, if you happen to be filing as a single individual, it is still a very impressive $6,000. And I want to make something absolutely clear right from the start. This is not some kind of trick or gimmick. This is genuine money that gets to stay sitting in your bank account rather than being sent straight off to the government. Okay, so what exactly is this new benefit all about? Let us break the whole thing down right here in this first section. We are going to refer to it as the new senior deduction, and we are going to get into precisely what this new rule actually is, where it came from, and why it has the potential to be such a genuine game changer for so many people who are already retired. The official title for this benefit is the Senior Bonus Deduction, and as you will see right here on screen, it is a temporary additional deduction that applies specifically to taxpayers who are 65 years old and above. It was included as part of a much broader package of tax law changes, and it was truly designed to deliver some much-needed financial relief to older Americans across the country. Now, here is what makes this particular benefit so remarkably powerful. And this right here is the key point. It stacks. This bonus deduction does not replace anything that you are already receiving. Instead, it gets layered directly on top of your regular standard deduction. And it also gets layered on top of that additional deduction you already receive simply for being over the age of 65. Think of it like building blocks. You start with your foundation, you place another block on top of that, and then you get to set this significant new one right on top of everything else. And that stacking effect is precisely what makes the total potential deduction so extraordinarily large. All right, let us move forward and look at exactly how all of this plays out in the real world. In this next section, we are going to calculate your potential benefit. This is where things get really concrete. You are about to see the full picture of what is happening here and just how much of your retirement income you could potentially shield from federal taxes altogether. And let me tell you right now, the numbers are genuinely remarkable. Okay, let us actually run through the math together. For a single individual who is 65 or older, for the 2025 tax year, the standard deduction is projected to come in at approximately $15,750. Now, because you are over 65, you already receive an existing additional deduction worth $2,000. But now you get to add another $6,000 right on top of that from this brand new senior bonus. So when you add it all together, you arrive at a total deduction of $23,750. Just take a moment to let that really sink in. That is nearly $24,000 of your income that is completely protected from federal taxation before you owe the government a single penny. Now hold on, because for married couples where both partners are over 65, the numbers become even more impressive. The standard deduction for those filing jointly comes to $29,200. Then, since you are both over 65, you each receive that extra age-based deduction, and together those add up to $3,200. Then you pile the $12,000 senior bonus right on top of all of that. That is $6,000 for each spouse combined. All of a sudden, you are looking at protecting over $44,000 of your combined income from federal taxes entirely. I am going to say that one more time slowly so it truly registers. $44,400. That is absolutely not pocket change. For anyone who is working hard to make their retirement savings stretch as far as possible, that is an enormous, enormous deal. And here is the part that sets this benefit apart from just about anything else currently out there. This deduction is available to you regardless of whether you choose to itemize your deductions or simply take the standard deduction. This is, frankly, pretty much without precedent. The tax code typically forces you to pick a lane. You either itemize or you go with the standard deduction, and that is the end of it. But this particular benefit works no matter which direction you choose to go. So if you are the type of person who prefers to keep things simple and just go with the standard deduction, that is perfectly fine because you still qualify for this. And if you are the type of person who carefully itemizes every single individual expense throughout the year, you qualify for this too. It is remarkably flexible in that way. Okay, so of course, with any government program, there is always some fine print involved, right? So let us talk about the limitations. We need to go over who actually qualifies and, just as importantly, for exactly how long. This is where things can get a little more involved, and it is where you genuinely need to stay focused to make sure you can take full advantage of everything available to you. This timeline right here may very well be one of the most critical pieces of information in this entire breakdown. You need to understand clearly that this is not a permanent change to the tax code. Let me say that again because it is absolutely essential. This deduction is temporary. It is only in effect for the tax years 2025, 2026, 2027, and 2028. That is the entire window. So unless Congress comes along and chooses to extend it, this additional deduction will simply vanish once you file your 2028 taxes. This means you need to be thinking about this right now and factoring this 4-year countdown into any significant financial decisions you are making during this period. The other major piece of fine print is, as you probably already guessed, your income level. This benefit was specifically designed to deliver the greatest amount of relief to low and middle income seniors. So there are income limits in place that determine whether you are eligible for the full deduction amount. This is what is commonly referred to as a phase out. So here are the specific numbers you absolutely need to know. If you are a single filer, the deduction begins to shrink once your income reaches $75,000, and it disappears completely once your income hits $175,000. For married couples who are filing jointly, that phase out begins at $150,000, and the deduction is completely eliminated at $250,000. It is absolutely critical that you know exactly where your income stands in relation to these thresholds. So how does that phase out actually function in practice? Well, there is a specific formula used to calculate it, and it is fairly straightforward. For every $1,000 you earn above that income threshold we just discussed, your bonus deduction gets reduced by $60. What this means in practical terms is that even if your income falls somewhere within that phase-out range, it does not mean you receive nothing at all. Every single dollar of the deduction you are still able to claim represents real money that stays in your pocket. It simply means you will not receive the full $6,000 or $12,000. Okay, so now you know what this benefit is. You know who qualifies for it. Now comes the most important part of all. How do you actually go about claiming it? And the encouraging news is that the process is not nearly as complicated as you might be expecting. But you do need to know the correct steps to follow. A lot of people hear about a brand new deduction and automatically assume it just gets applied for them, but that is not how it works. You have to actively claim this benefit yourself. Here is a straightforward 3-step guide to help you do exactly that. First, when you sit down to file your 2025 taxes, which remember you will be doing in the early part of 2026, you will want to use Form 1040-SR. That is the version of the tax return specifically designed with seniors in mind, featuring larger print and clearer, more straightforward instructions. It is significantly easier to work through. Second, on that form, you will find a checkbox that you need to mark indicating that you are 65 or older. That one small check mark is what triggers the entire benefit. And finally, you will need to fill out a brand new form called Schedule 1A. That is the form where you will specifically calculate the amount of your bonus deduction. Now, let us go ahead and address something that is generating a tremendous amount of confusion right now. There is a rumor circulating that this new deduction completely wipes out all taxes on your Social Security benefits altogether. So is there any truth to that? Let us clear this up right now, because getting this wrong could lead you to make some very significant financial mistakes. Let me be completely and unambiguously clear on this point. That rumor is entirely false. It is simply not accurate. This deduction does not directly eliminate the taxation of your Social Security benefits. The existing rules governing how Social Security income gets taxed remain exactly the same as they were before. So what does this deduction actually do then? It reduces your overall taxable income. And by bringing your taxable income down, it may have an indirect effect in that it could lower the portion of your Social Security benefits that ends up being subject to tax. But it is not some kind of magic solution that makes all of your Social Security income completely tax-free overnight. That said, for a great many retirees who have more modest income levels, the combined practical effect of all these stacked deductions can absolutely result in a federal tax bill of zero. Okay, let us bring everything together now with the final takeaway. We have walked through all of the numbers and all of the rules. So let us talk about why this genuinely matters for your retirement situation. This is not just some abstract exercise in accounting. It is a real policy measure designed to address the very real financial pressures that enormous numbers of seniors are navigating on a daily basis right now. So what does all of this actually translate to in real dollars and cents? Well, that $6,000 deduction is not simply a number printed on a tax form. If you happen to be in the 22% federal tax bracket, that $6,000 deduction saves you approximately $1,320 in actual taxes owed. Real, tangible cash. And that is money you can put toward prescription medications, or use to cover your Medicare premiums, or handle that unexpected vehicle repair that always seems to come along at the worst possible time. For anyone living on a fixed income, that represents a truly meaningful amount of financial breathing room. So if you take nothing else away from this entire breakdown, let it be these core points. First, you must be 65 or older to qualify. Second, this benefit is available even if you are still doing some part-time work, provided your income stays within the established limits. Third, it applies whether you itemize your deductions or simply take the standard deduction. Fourth, you absolutely must pay attention to those income phase-out thresholds. And finally, and perhaps most importantly of all, keep in mind that this is temporary. It is only available for tax years 2025 through 2028. I just want to leave you with one final thought before we wrap up. Please do not walk away from money that rightfully belongs to you simply because you were not entirely sure how this deduction works or because the whole thing felt a bit too overwhelming to deal with. This is a benefit that was specifically created to support seniors. So start giving it serious thought right now. Begin gathering your documents and make absolutely certain that you are claiming every single dollar that you are legally entitled to receive. And one final and truly critical warning to close things out: please be extremely careful out there. I can guarantee you that scams are going to be popping up everywhere, with people attempting to charge you fees to help you claim this deduction on your behalf. You do not need to pay anyone a single cent for this. All of the relevant information and all of the necessary forms are available completely free of charge directly from the IRS, and any reputable tax preparation software will handle the calculations for you automatically. So please stay smart, stay cautious, and do not fall for any of it. And that brings us to our closing question for you to sit with. This is a 4-year window of opportunity, a window that, as things currently stand, is set to close firmly after 2028. It genuinely calls for you to think strategically about your retirement income across these next several years. So, knowing that this significant benefit comes with an expiration date attached to it, what is your plan for making the absolute most of it while you still have the chance?